Welcome, Kevin.
Yeah, thank you. Appreciate it. Thanks for having me.
They're clapping for you because I know people are about to start booing me. I don't know why I signed up for 35 fireside chats for this one. So
you must be
in your
tired.
survey card, if you want to see less of me next year, I will pay you $5 on the way out so that I can have a little bit of a break. So Kevin was invited by our programming team, not me, because I thought I would have been doxing you. And then I found out that we were going to have a chance to do a fireside chat. I was like, hell yeah. But I didn't think that I didn't think that Kevin did see these public appearances. You stayed pretty under the radar.
Yeah, definitely.
Except for your epic tomahawk dunks when you've been right about a thesis, and you've had a couple of them, which we're going to talk about. But why don't we just talk a little bit about the firm and your background and some of the unique perspective that you bring to this conversation, because we've had a handful of these firesides with investors. All of them have a different bent. And obviously, you've got a unique perspective with background in high-frequency trading and about a pretty couple of good runs and counter trades. Contrarian and right, I think, is maybe the best way to describe some of your trades more recently. So just a little bit about the firm, and we'll use that as a jumping-off point for where the market's heading next.
Sure, yeah, that sounds good. So, really appreciate you guys having me here. Overall, I think with our firm, we're mostly known for, doing some of these antics on Twitter, pouring salt on some wounds, been accused of grave dancing, adding some spice to the flavor of Twitter. But actually, mostly of what we do is mostly market neutral trading, and very rarely do we actually ever short. So, one of the things I wanted to open up about first, just to start, is that I actually think it's a really bad idea for the most part to short. If you really think about it, there's borrow costs involved. You could get liquidated if the price moves against you in the short term. You basically have a bunch of people in the industry that don't like you. So there's a lot of different reasons that you might not want to short. But I think if you had to short, I think there'd be a lot of different ways of going about it. But for our firm at least, we focus mostly on market neutral strategies and in particular market making. So that's sort of what we do at Galois Capital. And for myself, generally, usually I don't do too many media appearances or anything like that. I'm a little bit more active on Twitter, and it's because generally the nature of the business that we're in, that usually prop shops do, that these market neutral funds do. There's no real reason to be loud about anything or really to share alpha. But I think this time around, as with Luna, as with the merge narrative, I thought it was a good idea to kind of sound the alarm, and I thought it was good for the industry. And there was enough alpha to go around, so it wasn't something that we could take down all ourselves. Yeah.
Is it survivorship bias, or do you think that there's certain things that you've studied that give you a certain edge in some of these theses that you have, or is it more meta where you just got to turn the blinders on? Let me just look at the facts.
Yeah.
Let me stay out of the echo chambers. Let me avoid, or try to de-bias or de-risk all of my potential biases just to be able to think clearly about a given position, or are you just on the lucky side of the bell curve right now? Right? How do you replicate that results that you've had in the last couple of years? Is there a secret?
I think that's probably giving us too much credit. I think I'm very solidly in the middle of the bell curve. I think really some of the plays that we made and that we were loud about on the short side, in my opinion, was actually kind of common sense, right? In retrospect, how could it have gone any other way with Terra Luna, for example? Maybe it would have, busted out earlier. Maybe it would have blown up later. But I think inevitably, the mechanism itself, at some point has to blow up, right? So I think a lot of it just comes down to, just trying to figure out how other people are thinking about something, where their incentives are, and at some point, if everybody believes something, generally doing the opposite is very profitable, right? So it's if 80% believe something, 20% don't believe it, that's probably not enough edge. But when you have 99.9% of people on CT all promoting the same narrative, then even if it's very unlikely that they're wrong, just like you only need to be right like 1 in 1,000, right? So it's generally like for these very small probabilities, very positive expected value to take the other side, just regardless of what it even is. Even without studying it, I think it makes sense just to do the opposite of literally what everybody else is doing. So I think, some of it is that, and I think some of it is just figuring out the narratives of how these bubbles get created in the first place, and sort of like who are the beneficiaries, right? You see the flow of capital from VCs going into these projects, then these projects subsidizing yield in their protocols, and then that attracting retail attention, and that hence giving enough liquidity for the VCs to exit at multiples or at very high returns. So that's kind of the natural sort of cycle of life. And then I think what's really important to think about is like what part of the cycle are we in there, and sort of like who are the beneficiaries, who are the winners and the losers, that are participating in each of these different things. Yeah.
There's an irony here, and I may have said this on a podcast before, but my co-founder Dan and I actually considered starting an activist fund called Galois Capital that we were kicking around before we started Messari. And it was like the height of like the 2017 euphoria. And to your point about do not short in general, the reason we didn't is we didn't trust the reference prices. We didn't trust like the markets were legitimate that we would have been going short on. We thought we could have busted out and kind of gone bust. And we didn't want to be hated. And I didn't have the balls to be disliked. So instead, we just decided to focus on disclosures and data. So I generally agree with that that mindset that shorting is generally a bad idea in a market that has moved like this over the long term. But I think there is a value in market making and kind of trading in terms of keeping the market honest and efficient.
Yeah.
My question for you is, right now it seems like there's a lot of alpha to be had if you have a background, a true professional background in trading and risk management, because there's so many retail participants in the market, and there's so many people that I think have gotten wealthy, maybe prematurely, and they get a false sense of security, a false sense of confidence. How much do you think that's getting competed away with some of the new entrants to the space? Do you think it's going to be harder to find those like 99.9% bets as we go through this next cycle? Or do you think that the washout of the market has kept the professionals, the institutions on the sidelines, so the crypto native funds that have the backgrounds that you have will still be able to find edge?
Yeah, so I think that definitely with the game itself in the markets and trading, it only gets harder over time. And I think you see that in traditional markets as well as in crypto. So I wouldn't be surprised if there's more and more challengers and incumbents coming into the space from the traditional sort of trading side. And I think that over time, what you do see is as the market gets more efficient, spreads start to tighten, liquidity gets thicker, it's easier to execute, but edge is harder to find. And I think that that's kind of what we're seeing in crypto too, with the advent of, HFT, with, these very strong shops, some of which you had as panelists, like, Jump Tower, HRT, a lot of these HFT firms. It definitely makes it harder for everybody who's currently in the space. But at the same time, I also think that the space itself is growing and there's more pie to be had. And then on top of that, there is some kind of overcoming that these TradFi native shops need to overcome to really understand the idiosyncrasies of crypto. So it's like a race on both sides, right? The crypto native firms need to basically research and basically rediscover all the things that these TradFi firms have discovered in terms of their quant modeling, in terms of their infrastructure. And then at the same time, all of these TradFi shops need to study crypto and understand the long history of crypto, all the experiments that have been tried, haven't been tried, looking at the very intricate mechanisms. So it's kind of like a race from both sides to understand each other's industry.
Are you focused on spot markets, futures, options? Some of these are very thinly traded right now.
Yeah.
And do you view an opportunity in market making, because it kind of kills two birds with one stone? You're both providing liquidity and you have edge because you're participating in illiquid kind of novel markets? Or do you try to concentrate where the liquidity is and you just think directionally the market is wrong?
Yeah, so I think that there's a lot of firms out there, like Wintermute and GSR, that do a lot of these like token market making contracts. That's not what we do. We mostly just focus on the majors and the more liquid contracts and assets, and it's not like a partnership with some kind of project. So for that, I think there's a lot of different considerations and things that you can think about. You can think about, like, for example, like how fast is your latency, right? Like the moment like a packet leaves your network adapter to the moment that it's received by an exchange, that's like you're kind of like on the wire external latency. And then there's also like the moment and new information it reaches your network adapter to the moment that you can ingest it and your strategy can process it, and then to send out some kind of order request, right? Like that's your internal tick-to-trade latency. So there's a lot of these kinds of considerations. There's also considerations for like, do you have any kind of edge from your quant model? Like, do you think that over the next 10 seconds or 5 seconds, price is slightly more likely to move up versus down, right? And then that can help inform where you put your quotes, right? You could be maybe skewing your bids and offers slightly higher or slightly lower, but this is really just like kind of like grinding out like single digit bips or like half a bip or fractions of a basis point, but on very, very short time frames, which then you try and repeat millions or billions of times, right? So like these are sort of like the considerations, these kinds of microstructure mechanical considerations that I think are very important for the type of work that we do. Yeah.
Let's go sector by sector. So okay, let's say spot is where you're spending some of your time and energy. Is there a cutoff that you have by market cap, or do you think that there's opportunities in certain segments, whether it's layer ones, DeFi? How do you rotate where you concentrate your positions? Or is it kind of like all over the map, you have a team that's boiling the ocean, thinking about where the inefficiencies are, and then you just exploit it regardless of kind of where it is?
Yeah, so I think what I would say is that I think at these very short time frames, the underlying asset doesn't matter that much. So it's up until the point that we can get borrow, right? Because like to market make some of these really illiquid assets, you need to be able to source them to be able to offer them in the spot market in the first place. So like unless you can get those borrows from the team or from investors, who then obviously are then questioning why you even want to borrow from them in the first place, right? Because then they might be scared that you're shorting, or you have to pay exorbitant interest rates to borrow. Then that makes it a little bit prohibitive, right? But I think for the very liquid majors, it's pretty easy to get borrows from all the lending desks, Genesis, BlockFi, and then even on obviously on DeFi too, with Compound and Aave. So places where you can easily source borrow, that gives you balance sheet to be able to make on the offer side. Yeah.
After Q2, did that get tougher between risk departments actually taking their job seriously from the lending desks and interest rates rising, right? So like cost of borrow is going up structurally in a couple different ways at the same time. Liquidity and prices are going the other direction. So do you just sit on your hands for the next little bit, or like what's the play?
Yeah, no, absolutely. It's definitely gotten harder because borrows are harder to source, and you have to over-collateralize all your borrows with the desk now. Before, they were giving out under-collateralized loans. They were giving, uncollateralized loans entirely. But after the whole 3AC saga, they're a lot more tight about risk, which, I think reasonably so. So I think at this point, it's just a lot more difficult, and borrow costs are higher. So there's some things that are just harder to do, and you just maybe stop doing them, or you have a higher threshold for when you actually want to make markets there. If you really think you can get more EV or edge than whatever cost that you're paying in the short term. And there could be like bursts of activity, right? You don't have to borrow for a very long period of time. Maybe there's a huge event that's about to happen, like the merge or something like that. Borrow it for 3 days, return it, and then very quickly afterwards, you don't pay that much, in absolute terms, even if the rate itself is very high. Yeah.
How far out do you usually have a window or a thesis? Obviously, your bread and butter is there's a current dislocation we can exploit right now. How do we do it? But is there, do you have medium and long-term positions that you want to put on right now, or kind of like contrarian bets that you're like waiting for the right moment to enter a trade?
So I think, I just, maybe just to say that like most of the activity that we do doesn't consider things in the midterm anyway. But if I were to think about the midterm, the way I go about it is just thinking about like what things are related to other things, right? Like for example, like obviously Luna Classic and Luna 2.0 are very closely related with each other. ETH proof of work and ETH and ETC and ETH itself they're very closely related to each other. So maybe there's some kind of correlation trade that you can do there. Maybe you could say that like the sum of these two things, you know what it is, but you don't know how it's divided between the two, but they should add up to something which is fairly steady. So there's all sorts of like considerations like that. You could also say like with these new projects like Aptos and Sui, are they more competitive with a coin like Solana, or are they more competitive with a coin like Ethereum, for example, right? And that can help form a thesis around like whether you want to do that as like a pair trade, whether you favor one thing versus the other, long one, short the other, that sort of thing. And then there's also considerations about like very idiosyncratic behavior of certain coins. Like for example, generally Bitcoin is a nice hedge to have if you're like doing long short activity in some of these alts, right? So you calculate the beta of that alt to Bitcoin, and then maybe you long or short some proportionate amount, on the Bitcoin side to kind of hedge macro exposure because everything's very correlated there, or just like crypto macro exposure because cryptos generally are correlated. But then like now with the GOX coins, maybe being released and entering into circulation, now there's something very idiosyncratic about Bitcoin. So then it's like, well, maybe that's no longer as good of a hedge as it used to be. Maybe we should try and find something else. Well, and then you think, well, maybe should we use Dogecoin? Well, no, I mean, then Elon just makes a tweet and this thing can just have super high volatility. It can go anywhere, right? So then maybe like Litecoin, yeah, maybe we just use Litecoin, like maybe its only use is to serve as a beta hedge where Bitcoin doesn't serve that properly, right? So like those are some ways that you can think about like the characteristics of the coins and how they like interplay with each other. And that's generally kind of how we form our midterm views. But like I said, it's pretty rare that we even express midterm views in the first place because it's not really a main part of our business. No.
Let's talk about duration versus arbitrage. So, I hear a lot of people throw out the term arbitrage, and then that's how I know that they have no sense of risk management. Three Arrows was on the wrong side of 3 trades where duration killed them in a row in size.
Yes.
Right? They were on the wrong side of the GBTC trade where they thought they would get a premium forever. It flipped to a discount, and then they had all this bad collateral. Then they were on the wrong side of the Luna trade. And then they were on the wrong side of the staked ETH versus ETH trade. So were you just on the right side of all 3 of those? So like the entire balance sheet from 3 Arrows is now under Galois? Or
no, it wasn't that much, no. I'd say that...
how do you, so I'm being tongue-in-cheek, how do you think about duration, arbitrage, and like some of the hidden risks in some of these synthetic trades?
Yeah, so what I would say is that like, most pure arbitrages don't really exist, and sometimes there's this illusion of arbitrage, right? There's this like illusion of free money, right? Like for example, like this idea of like, oh, you put your UST into Anchor and you make 19.5 or 20% annualized, really calls the question like, but where is that really coming from? And I think like the example that you brought up with Grayscale and ST-ETH against ETH is kind of like the same idea, which is that it seems like that there's a play to be made here, which is free money, but actually it's not the case because when you look at sort of the minutia of like what's actually going on, you have these 2 assets that are not actually fungible with each other. And I'll give you another example too, which is like normally the way that we think about like, let's say Bitcoin on one exchange versus Bitcoin on another exchange. Generally, there's an arbitrage to do, but only if deposits and withdrawals are open for both exchanges, right? The moment deposits and withdrawals are closed, well then, now you have this kind of duration risk. Maybe in the long run, as long as they reopen at some point, then you can close the arb. But let's say you start legging into this thing where it's like deposits and withdrawals on FTX and Binance are closed, the prices are super deviated, right? Are you actually making this arbitrage, or are you just hoping that deposits and withdrawals are going to open and it's not that one exchange is insolvent, right? Because back in the early days with MT Gox, I mean, those Bitcoins on exchange started trading at like 20 cents on the dollar, but that's not an arbitrage. You buy it on Gox, then eventually after waiting like 8 years, 10 years, then you get about 20 cents on the dollar, right? So that would be a really terrible arbitrage. So I would say that even the same asset itself, you have to really consider its fungibility, let alone like staked ETH versus ETH, right? Or any of these other examples, but even like ETH against ETH or Bitcoin against Bitcoin, there's like you're subsuming invisible counterparty risk of where these coins are being held. And I think a lot of times people are not considering that, right? So like I think those are some considerations that are really important. Yeah.
All right, last question. It's the lightning round question. Not financial advice. Your mileage may vary. Do your own research. Yada 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 yada. Everybody wants to hear the alpha. All right.
Okay.
Say the tweet out loud. What's the next big contrarian and right shit post?
Yeah, I think actually right now it actually makes sense to be contrarian on the bull side because things are so depressed and so bleak. I actually almost want a long. So I know that's a little bit unexpected to be on the panel of shorting to say that, but I almost feel like things are almost too bleak right now. So I'm actually considering a long right now.
You almost want a long.
Yeah.
The whole thing, the whole shebang, the whole asset class, or one asset?
Probably just the majors. I mean, I play things pretty safe, so just some kind of blend across the majors or something like that, but not financial advice at all, you know.
So there you have it. Kevin Zhou is a trend follower for my trades from earlier this week, which I published online, and I'm on the right track. Everybody knows I'm a world-class trader and have never been wrong.
Absolutely.
So actually, please do not think about that for 1 second. I'm a horrible trader. We have
Ryan
the best in the business here.
Advice. What he says is financial advice. Absolutely.
Yes. If I was a great trader, I wouldn't be hosting these conferences because they're too much work. So, Kevin, thank you for joining us. Great to meet you in person. He's real.
Yeah.
Everyone.
Likewise. Appreciate it. Thanks for having me. Yeah.
Thanks, man.
Yeah. Absolutely.